Hi, Tom.
Hi, Ann. How are you?
Good, thank you. How are you?
Good. Let me dismiss and share. Oh, there it is. All right. See the matrix?
I do. Awesome.
Okay. Good, good. I'm going to be starting from here, so I thought I'd just bring it up.
Sounds good. Give it a minute or 30 seconds or so. I just can see people coming in.
Okay.
We don't exactly have a Halloween one this year, but close enough to say happy Halloween.
Yeah.
Okay, awesome. I think looks like we have quite a group, so I think we can get started. Just first, hello everyone, and thank you for joining us to this risk readiness webinar in this installment in the credit trends in commercial lending. It's presented by ProSight and our partners at AFS. We're happy to have you here and excited to see what Tom is about to share during the presentation. If you have any questions, just please use the Q&A at the bottom and we'll address them as soon as we can. So at this point, Tom, I'd like to turn it over to you. Thank you.
Thanks, Ann. And hello to everybody today, pre-Halloween. Uh, Today we have the third quarter results, and we'll have a number of charts that compare 3Q25 to the beginning of the year, kind of our, half, 3/4 of the way there. And the overriding question for today is, do we see cockroaches or do we see one-offs? To sort of paraphrase Jamie Dimon there. And we're getting conflicting signals in the marketplace. The stock market is at or near record highs, and yet there's been a lot of announcements of massive layoffs just in the last couple of weeks. Notably, Amazon, UPS, Target, GM, and Booz Allen, and then Molson Coors I saw is laying off people. So to help us get the answer to cockroaches or one-offs, I'm going to do something a little different. And I'm starting with, as you can see, the live version of our risk migration webpage. We're going to talk a little bit about commercial real estate and C&I credit quality and risk migration, and what's been happening with credit quality for a couple of specific property types and a couple of specific industries to try to get an idea of what's going on. Uh, Sometimes the macro picture or the overall picture says one thing, and then some of these individual pieces tell you something else. And so that's what we want to focus on today. And as always, this analysis and comments are my own and are not meant as investment advice. So let's get started with CRE borrowers, which is what I've selected here. And I'm on the CRE borrower count. Uh, what you're seeing are CRE borrowers that were in the database as of September 2024 and are still in the database as of September 2025. If you look at the chart on the upper left, so the pass to criticize and criticize to pass, I'm going to pull this in as a table so it shows a little bit better. So what this is saying is that the red are borrowers, or the percent of borrowers that were pass 12 months ago but are now criticized. The green is just the opposite. These were borrowers that were criticized that now moved to pass. And just as a reminder, when we bring borrowers and cut banks into the Credit Risk Navigator, we translate that bank's, pardon me, native borrower rating scale into the ProSight 10-point scale. On that 10-point scale, 1 through 10 are, well, excuse me, 1 through 6 are pass, 7 through 10 are criticized following the regulator definition. So criticized, 7 would be special mention, 8 substandard, 9 doubtful, 10 loss. And then the 1 through 6, the 1 being the most pristine and the 6 being low pass. So, as you go from 1 to 6, the credits get worse. So what you see here, and again, this is pass to criticize to pass for CRE borrowers, is that every property type is showing more borrowers going to criticize then coming back into pass. And a couple have twice the number of downgrades to criticize versus upgrades to pass. Notably, the multifamily here, so it's actually 3-2. Office is 4-2. Lodging is 4-3. So we're going to look at some of these as well. But you can see the overriding shift here is a downturn in credit quality. Let's go back to the main report and we'll come over to our transition matrix. And I'm going to blow this one up too, so you're a little bit easier to see. And I'll explain this a little bit for those of you who haven't seen it. On the downward column, this is what the borrowers was rated as of September of 24. Going across is what the rating is as of September of 25. So if you look in this first column here, first cell, where one on the left, one on the above it, this is saying that 66% of the borrowers that were risk rated a 1 are still a 1 12 months later. If you come over, 10% of those 1s are now 2s, 7%, 6, 7% are now 3s, etc. So you can see how it's migrating. The assumption that I've had for a long time, and partly borne out by the work we did with the CCAR portfolios, I guess 5 years or more now, was that the tails, so these 1, 2s, and 3s, they should be fairly stable. And the bottom tails, the 8, 9s, and 10s, should be stable too. If you rate something substandard or doubtful, it's not likely it's going to move out of that category. That you're pretty much writing it off. The same, I thought, held true for the 1s, 2s, and 3s. And I've been talking to some of my colleagues, especially my friend Kent Kirby from Commerce today. He said that when they would rate something a 1, that was ironclad. It didn't move. And so I wasn't expecting what you're seeing here. Again, this is CRE. And so what we're saying is that 66% of the borrowers that were risk rated a 1 a year ago are now downgraded. Some of them, 10% a notch, no big deal. But then if you look at the double notches and the triple notches, so you're talking 6, 14, 20, 20%. So 1 out of every 5 CRE borrowers has been downgraded at least 2 notches. It gets even worse if you look at the 2s. So the 1s are probably very pristine. The 2s have to be pretty good too. Only 58% of those are holding. And then the 3s at 64%. So there's definitely a shift to the right, a downgrade. All right. Let's take a look at a couple specific property types just to get a feel for where some of this is happening. The first one I want to look at is industrial. Pardon. So this was one where the pass to criticize, 4% went pass to criticize, only 2% came back. And more than 50% of the pass to criticize occurred for properties in the South, in the Southwest, and the West. You can see that from the pie chart. So it's kind of, as they say in CRE, it's location, location, location. And it's definitely 50% of the activity here is in the lower part of the country. If we click on industrial, you see it highlights, and then it also changed the matrix. I'm going to come over to the matrix, and I'll go back, display this as a table, so you can see it a little bit more. So once again, look at the movement for the top rated credits. So the 1s, so less than 50% of the 1s a year ago are still a 1. And 23% are now 4. So that's a 3-notch downgrade, and 11% of 5. If you look at the 2s, it's even worse. Only 42% of the 2s are still a 2. A lot more. There's some actually got upgraded, which is good, but a lot more have been downgraded. And I expect some movement, even at the high levels, but I expect what I call drifting, not these swift corrections or the rush to the right. And 25% of the best rated borrowers being downgraded 3 notches inside 12 months appears to me to be very extreme. And so with industrial properties, what's happening? Why, what are we hearing that's causing this? So a couple of things. First of all, the oversupply. Um, if you remember 2021, 20 and 2021, nobody could go anywhere. You couldn't shop. Everybody was shopping on Amazon.com, and warehouses were popping up everywhere to handle the e-commerce load. E-commerce sales have slowed down. They're still very popular, but they slowed down, and you've got a lot of warehouses that were built on as specs and just have not been leased. The net absorption rate has declined substantially. The other thing we're hearing is that there are a lot of older buildings out there now without the new features. For instance, 30-foot ceilings. There's a lot of buildings out there with 18-foot ceilings, and these are being hard to rent. So there's a variety of headwinds out there that are causing some problems with industrial properties. Let's go back and look at another property. This time I'm going to go over and look at lodging. And I want to make sure I bring up my pie chart here. So again, with the location, pass to criticize is 4%, 3% criticized to pass, so almost half and half. But it's only happening, pass to criticize is only happening in 4 of the regions. The other regions are not seeing any of this. So what does this say? What do we see with the matrix? So let's go over and I'll show as a table. Oh, not sure how I got that there. So let me go back, clear that out. Try again. This is the danger of doing it live. So here we are with lodging. And if you look in the upper right corner, only 20% of the hotel facilities that were rated a 1 are still a 1. And 60% of them are now risk rated a 4. A 4 is not bad. That's still above average, but still the ones, are pristine, supposed to be pristine credits. And for that many to move that quickly, to me, it's just astonishing. You see the same thing with the 2s, maybe even a little bit more dramatic. So only 21% are stayed a 2, 30% are a 4, 15. So another 30% are down 2 to 3 notches. You even had one that went into substandard. The 3's a little bit better, 50%, but still, just a lot of movement here. With hotels, with lodging, the obvious answer is, when you ask why, is a decline in occupancy, especially from international travel, and especially from the Canadians when the tariffs went in effect. Also, what you're seeing is an increase in alternatives being used, particularly by young people. And we're going to mention young people and their habits a couple times today. So Airbnb and Vrbo. I know my daughter and my son, my daughter's in her 30s, my son is in his 40s. They don't look at hotels anymore. When they go on a trip, the first thing they do is, where's the Airbnb and where's the nearest Vrbo? A hotel is kind of a last option for them. The other thing we're hearing about why there's some issues with lodging and why they're being downgraded is there's a lot of lodging properties being refinanced in 2025 and 2026. And these properties were 3 to 4 year term, 5-year terms. They were originally underwritten with very low interest rates, and now they're looking at interest rates that are probably double where they used to be. So the combination of doubling the interest rates or the interest cost and less occupancy, so less income, is going to cause problems there. I'll go back and look at one more, and then we'll look at some C&I stuff. So here's multifamily, and you can see that almost half of it is in the Southwest. Almost half of the pass to criticize is in the Southwest and the South, which just a few years ago was the hot market. Texas, Atlanta, places like that. Excuse me. So it's not too bad pass to criticize. We criticize the pass, but it is very local. Let's go look at the matrix. And I'll show this as a table. Now here, the upper tiers, again, I'm going to focus on the upper tiers. Not as bad as what we just saw with lodging, but still, 66% of the ones are still a one. You've got a number of, a large portion, what's this, 15% or more that are downgraded 3 notches. The twos, you actually had one that got upgraded, but then you've got the downgrades again. So that's 21% plus 2 notches or more. So a lot of movement here, a lot of movement to the right, and not drifting, if you would, but some rushing, if you would. And why? What's happening with multifamily? So very timely for me. If you get the Wall Street Journal, pull yesterday's Wall Street Journal and look on page B1, and on the right-hand side, you'll see an article about why apartment properties are having problems. It's another example of oversupply. And most of the new supply is Class A buildings, which have been more costly to build due to inflation, which in turn commands higher rent. But the oversupply and then the increase in unemployment from the 20 to 24-year-old category, again, the young people, is holding down rents. So there's a lot of headwinds here with multifamily properties. So now I'm going to go back and switch to C&I borrowers. So I'm going to click here to C&I borrowers. And now you see that we have, instead of by property type, we have it by 2-digit NAICS code. And let's look at the pass to criticize. And again, I'll pull it so it's a little bit easier to see. A little squished, but still easy to see. And here, with the exception of NAICS 92, which is public administration, way over there on the right-hand side, every industry has more red than green. So more borrowers have entered into the criticized realm than came out of it. You have a couple that are at a 5-to-1 ratio. I think it's transportation, 48 transportation. Yep, 5-to-1. 2 of them are at 4-to-1. So a lot of movement in the past 12 months to worse credits. If you look at the matrix, I'll pull it up as a table. Not quite as bad as what we saw with CRE. Matter of fact, the ones, 91% of the ones are still a one. 5% went down a notch, and then just a couple went down a little bit more. This is probably 1 or 2 loans, 1 or 2 borrowers. To go from a 1 to an 8, not ideal, but I guess it could happen. The 79%, that's probably a little surprising. The threes, and for those of you who have been with me before, the threes would really surprise me. There's 62% just stayed a 3. And a 3 should be a really good credit. It shouldn't be something that's moving. Now, maybe if it moved down a notch, 22%, okay, that's not bad. But 10% going 5 to 6s, that's just a lot of movement to me, showing that something's happening in the last 12 months in credit quality with banks. Pardon me. Let's take look at a couple examples. Let's see if I can get construction here. We'll take a look at that first. So 3-to-1 pass, all right? And we'll go through and back over to the matrix. And I'll pull up the table. So 40% of the ones are still a 1. 20% got downgrade 2 notches, 20% got downgrade 4 notches, and 20% went into special mention. So the first question I had when I looked at this is, why did you have a construction company risk rated a 1? I guess there are borrowers out there, but in my experience, I never ran into a construction company, the basic nature of which would be a 1. Maybe there is a 1. But so and you can see the movement of these, which sort of enforces that theory. You look at the 2-to-2s, only 45% stayed 2. You have 22% went to a 4, 9% went to a 5, and you've got a couple going 7 and 8s as well. The 3s, 63% stayed a 3. 20% went down a notch. But again, you see some movement here to the right. And this is almost entirely due to inflation, the impact on the specialty contractors' costs, and also labor issues. One of the things you hear over and over from contractors is their inability to find skilled laborers and to pay them a decent wage. So there's a lot of headwinds there. Let's go back and look at another one. I'm going to clear this out. and we'll look at 42 wholesale. So here we have pass to criticize at 3, criticize to pass was a 1, sort of a mix. It's happening almost throughout the country. I don't see anything terrible there. We'll go look at the matrix, and I'll blow it up. So the 1-to-1, 70%, I guess that's okay. 9%, so that's probably a single borrower, went to an 8. The 2s, only 50% stayed 2. You had 20% go to a 4, 10% went to a 5. So that's 30% went down 2 notches or more. And then the 3s, about the same thing. Only 55% stayed there. And what's happening here with wholesale? So a couple of things. Obviously, increased competition. E-commerce, is hitting them. And then something that I had never heard of, and then I checked into it and found it's true. Apparently, one of the things that's happening with wholesalers is a lot of manufacturers, pardon me, are doing direct-to-consumer shipping, bypassing the wholesalers completely, so their market's drying out. So one more from our matrix. And I'm going to go over and pull retail trade. Oh, here we go. So pass to criticize is 3%. Criticize to pass is only 1. All right. And then if you look at the matrix itself, so 50% of the ones are still a 1, and somebody went down. I assume this is probably one borrower, dropped 2 notches. Look at the 2s. Only 32% of the 2s are still a 2. Now they're not in the 6, 7, 8 range, but you've got again a vast shift to the right side. And in in CRN, I don't have the names of the borrowers, but I suspect that a lot of this movement here for 44 retailers, because when I drop down, and we'll talk about this, I think a little bit later, a lot of this movement was for motor parts and vehicle parts. I have to believe that a lot of this is due to the reaction to the problems with First Brands and possibly Tricolor. Just banks saying, okay, we need to take a look at what's happening. Let's downgrade it. We saw that happen in 2017 with the oil and gas loans. Okay, so that's what I was going to show out of the risk migration. So I'm going to go over now and hopefully pull up our regularly scheduled program, if you would. But as I do that, let me just make a comment. So the risk migration charts and the matrix are new, and I think we're still trying to understand what the results say, how we can use them, and is a change in a given measure more important than a change in another measure? We're still working through that. But as we go through that process, one thing to me is abundantly clear. Over the past year to 18 months, for both C&I and CRE portfolio, both the C&I and CRE portfolio, banks are anticipating a decline in credit quality and a severe decline in credit quality. So whether it's cockroaches or one-offs, there's definitely some weak spots in the portfolios, as we've shown, and we'll continue to help you recognize those sectors. And I'll make a little pitch here. If you join the service, you get to see a little bit deeper how you compare to everybody else. And if you're interested, you'll see our information at the end of this PowerPoint. And also, I'll offer one more thing. If you like a screen print of anything I just showed you so far, please email me and let me know what you want to see. So now C&I, the performance of C&I. A quick definition of C&I. This is business purpose loans to private or public companies with annual revenue usually north of $1 million. These borrowers are manually underwritten and assigned a risk rating, so delinquency managed or system assigned risk rating borrowers are not included. With this chart, we present the service life trend for the 3 main performance measures. 30 to 59 days past due in the green, 60 to 89 days past due in the blue, and then non-performing, which is in the red. And I define non-performing as accruing loans that are 90 days plus past due, and then non-accruals. Let's take a quick look at the green. Almost 2 years ago, the short-term delinquency level appeared to be increasing. So you see there after 23, it was kind of flat, and then a bump up right before 24 to about 75%, 0.75. But since then, it's gradually come down. And in September of 2025, it's down to 0.19%. It's almost as close as to the low point as we've ever been. Now look at the red, non-performing. So if you go back to September of 2022, non-performing was at 0.65. Remember, we had come out of the initial shock of COVID and things seemed to be doing well. We were at 0.65. But then it started climbing. And since early 2024, the non-performing level has ranged from 0.82 to 0.90. It jumped up a bit this month. So we've gone from 0.89 to from 0.81 to 0.89. So the question I have, and obviously we got to keep an eye on this, is this a one-time event due to some of the issues we've had with again First Brands and Tricolor, or is this a sign of something that's going to happen? Continue. Let's take a look at NAICS codes. So excuse me a second. So for each NAICS code, you'll see a value for December 2024 in the blue square, and a value for September of 25, the gray square. And the difference between those, if that's colored in green, that means that the percent non-performing dropped or improved, so green is good. If it's red, the percent non-performing increased, so that's bad. And 16 of the 24 here really didn't move very much. Not a lot of movement. You see some where you really can't even tell the difference between the squares. The one with the most improvement, though, was agriculture. The ones with some of the problems were mining. Specifically, that was crude petroleum extraction. Come over a little bit more to the right, and there's wholesale, which we had talked about. Here, the wholesale distributors that are having issues are beer and wine, sporting goods, and then construction wholesalers. Come over a little bit more to the right, you see the increase there for information. This is media streaming. So all of these were off significantly over a 9-month period. Let's take a look at this by geography. And for C&I, when we say geography, this is based on the location of the borrower, not the bank. So 3 or worse, the Eastern Midwest, starting on the left side, it's worse because of problems with motor vehicle parts manufacturers. The Mid-Atlantic is the next one. That showed a decline. That's for sporting good wholesalers and media streamers that we just talked about. Come over a little bit more, you see problems with the Southwest, electronic stores, telecom, and food stores or restaurants. We'll talk a little bit more about that too. Only 2 are better, pardon me, the South and the Southwest. The Northeast is technically better, but I write that as being the same with the Western Midwest, just not enough movement there. So that's the performance. So let's move on and look at the criticized. So the credit quality, our traditional credit quality. And I'll preface this by saying you're going to see a little bit different look here versus what we just saw on the risk migration screen, partly because this is a 9-month view. The risk migration screen is a 12-month view. And we'll get to what I think is happening, but I just wanted to comment that. Again, we map banks' native borrower risk ratings to the ProSight 10-point scale. And what I'm showing here are the criticized and the 2 components of that. So the special mention, which is the 7s, are in the yellow, and then the classifieds, the 8, 9s, and 10s are in the red. And in late 2022, we had reached an all-time low for criticized loans. And again, CRN has been going on since 2023. So that was the best it had ever been in late 2022. From there, credit quality declined, and the poor ratings peaked in the spring of 2024. We're coming back down now, though. So we're where we were almost 2 years ago, still high above the peak, but definitely you can see the increase there throughout 2024. Let's look at by NAICS code. A little different story here than what we saw with the non-performing, sorry. So we're looking at the change in percent NAICS by the two-digit code, change in percent criticized by the two-digit NAICS code. And just a reminder, CRN can go all the way down to the six NAICS digit. Here we're just at 2. And what this is telling us is that only 3 industry sectors have a higher percent criticized as of September 25 versus the end of 2024. Those 3 are 22 utilities, and that's due to hydroelectric plants and wind plants. 72 accommodation. Just you can see the red there as we come across. That's food, which is restaurants. And I noticed just before I came in, or as I was getting ready here, I saw Chipotle stock, I guess, was down 19%. That was like I was at 12:30. Less demand for especially amongst the younger people. So again, comment on the younger people. And then the other one that's down, rather surprisingly to me, is 81 other services. And when I went down a little bit in that, I saw that was for religious organizations. So I'm not exactly sure what's happening there. That's something I'll take a look at and get back to you with. But most of these, the last 9 months look good. Remember, the risk migration is saying things look bad. So what that told me was that in the beginning, late September, October, November, December of last year, the banks, as they were heading into the year, were moving things down the scale, anticipating that 2025 was not going to be a great year. So I think that's what you see happening here. Geographically, every region improved with the exception of the Mid-Atlantic. Within the Mid-Atlantic, we saw some substantial increases for the following. 22, and that's where the hydro and solar were. 51, media streaming, which we had talked about. NAICS 54, advertising. NAICS 71, gambling. Again, things that are all consumer oriented. And then 72, food, or the restaurants, which we've talked about a couple of times. All right, let's move on to CRE. And here's how we define CRE borrowers. We follow the interagency guidelines that basically say if more than 50% of the loan repayment comes from the sale or rental of the property, that's CRE. You'll frequently hear these borrowers referred to as investor owned. So what's happening with CRE performance? So from September to August, all 3 CRE performance measures are either down or flat. And looking even further back, the non-performing number was at 156 as of January 2021. Since then, the overall CRE performance measures have basically been improving. And again, I stress that overall. We're going to see some differences when you peel back the onion, so to speak. We're now at 1.05% non-performing. So 156 almost 5 years ago, 105 now. So let's take a look at some of the property types and see what's happening. So again, this is December versus September. Everything improved except lodging, which was basically flat. That number is 146 versus 149. Even office properties improved. It went from 5.43% non-performing to 4.22%. It's still almost twice the next highest property type, but it's headed in the right direction. And there have been a number of comments, again, in the Wall Street Journal and other CRE trade publications about the resurgence of office occupancy, especially in New York City and even in San Francisco. So possibly you've turned the corner with offices, although there's still a lot out there that have problems. Let's look at regions. So again, here, geography is based on the location of the property, not the borrower. and almost every sector has improved. The one with the substantial decline was the Western Midwest. And that's primarily for lodging. Now, I did want to mention something about the non-performing number for CRE. And I don't know the exact percentage, but it's pretty clear that CRE non-performing loans are being underreported. It's hard to determine, as I said, the exact amount, but we're aware that a significant percentage of bank loans have been modified, which in turn has kept the percent non-performing lower than it actually is. So right now it's coming in at what I say 1.05. Is it 110? Is it 125? Is it 150? I don't know, but I know it's higher. And a lot of these, a good number of these loans have been modified that, and with the regulator's blessing, that in the past would have been put on non-accrual. So that number is actually higher than what it's showing here. Let's look at criticized. So in March of this year, 2025, you can see, on the right-hand side, you see the little blip, that's March. The total percent criticized was 12.6. And that's the highest level we had seen in CRN for CRE since late 2015. And the number in late 2015 was high because we were coming out of the recession. So CRE had gotten bad, almost as bad as it was coming out of the recession. Since that month, though, since March, it's improved. And we're now looking at a criticized level of 10.9%. So again, going back to the risk migration, a lot of the downgrades, if you would, were late 24, early 25, with the anticipation that 2025 was going to be a bad year. And it doesn't look like it's turned out to be as bad as we thought. Here's another change chart. This is the change in percent criticized. And there's really only one property type that's showing any significant change, and that's lodging. And we've talked about this. That is sort of a change similar to what we saw in office properties, kind of a, I guess you call it a macro or a social change, if you would, sort of a social change with lodging too. They're just not the attractive features there. I did want to mention before we leave this, I did want to mention retail because we've sort of touched on that a little bit. The percent criticized is up slightly. I'm sorry, I wanted to mention residential. So the percent criticized is up slightly. And the recent fourth quarter results from DR Horton, kind of one of the larger builders, is down. And they're saying that their margins are compressed due to larger incentives. Sales are still depressed. And the quote that they had in there was they're seeing ongoing affordability constraints. So you have to wonder what's going to happen with residential properties. Although I saw that, the Fed lowered the rates again. So, affordability might, come back into line a little bit, but that's something I think you ought to keep an eye on, what's happening with your residential properties. So one more look at criticized, this one again by geography. South's up a little bit, the Western Midwest is up a little bit. And we saw this with non-performing and in the Western Midwest. So that's the states that run from I think there's a graph in here or a map in here, so you'll see what we call Western Midwest. Lodging is having the highest increase in criticized, and office is next. So that's it for the September data. Now, we usually do these webcasts on the last Thursday of each month. Since last Thursday of November is Thanksgiving Day, we're going to push that webcast to the first Thursday of December, which will be December 4th. And that'll be our last webcast for 2025. And then we'll be back again in January or February of 26. We might move this to the first Thursday of every month, but we will be back on a monthly cadence. So Ann, I'll turn it back to you to see if there's any questions.
Great, thank you. We do have two. First, for a copy of the slides, yes, I'll be sending them out to the attendees. And then the second one is a comment that I think another reason for downgrades over the past year in CRE is a greater emphasis by regulators on debt service and whether lease up is occurring according to plan and is less reliance on guarantor strength. It's just observation.
Good insight. Good insight. Yep. Yeah, the CRE numbers, the downgrades, as I said, downgrading one notch, not a big deal. But 25% of your ones going down 2 to 3, 4 notches, that's telling me something. That something's not right with the overall impression of the market. So if anybody has any other comments of what you're seeing in your shop, if you want to shoot me an email, I'd be glad to hear what you think. Again, this risk migration stuff is kind of new, and we're still learning as what it means and how to use it.
So Tom, one thing I may have seen, I was doing quick math in my head, which is always risky. That's not my forte. But it almost seemed like if the original rating was 5, 6, or 7, it seemed like a greater percent went to the positive direction than the negative direction. Meaning that if you looked at that middle ground and try to compare how many improved over how many declined, it seemed like there was a little bit more of an aggressive push to being in an improved rating. And I guess I wonder, is that a matter of just resource constraints where you have to focus on that that group to try to get them to improve and just maybe don't have the time and attention to focus on some of them that are already in a better rating. I don't know. That's
I'll take a
something
look at that, and that's a good insight. That's some good insight. I'll
just
see.
something
I
else
know.
to look at.
Yeah, I know the 4, 5s, and 6s are sort of staying steady. So I'll take a look to see if they're shifting to the left, and maybe that'll give us some insight. Thank you for that.
Sure. Again, it's not, it was just kind of quick math in my head, so it may be a rabbit hole.
Okay.
Awesome. Let me see if we have any other questions. I'm not seeing any other questions at this point. Um, so again, so I think we'll conclude the webcast. Thank you so much for joining. Please do complete the survey that'll come out at the conclusion. Appreciate your attendance, appreciate your feedback, and I'll always appreciate you too, Tom. Thank you so much.
Thank you. Bye.
Awesome. Bye. Thank you.